Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscriber, so please be careful. Don't get yourself scammed. If you want 7 free stocks, Moomoo is going to give you 7 free stocks when you open a new Moomoo brokerage account. They're going to give you 7 free, magnificent 7 fractional share stocks. What an incredible offer to be able to get the magnificent 7 stocks for free. All you got to do is go down to the description box, click on that Moomoo link, open up your new Moomoo account today. Go get that free stock, go get that free money. Guys, we got a lot to cover today, so we're going to just dive right on into it. It looks as though in the 3rd day of April, 2024, that the Fed is going to rug pull us. They're not going to decrease or cut short-term interest rates this year. And investors know that. So that's why you're seeing the stock market, the crypto market start to fall apart. That optimism that investors have had for the last 90 days is disappearing. It is disappearing. And investors are starting to understand that this is a Fed rug pull. And here's what's supporting that Fed rug pull: the labor market. ADP came out with their private payroll data for March 2024. And it looks as though they're saying that the private sector is going to add 185,000 jobs to the economy. That beats expectations of 150,000 jobs being added to the economy. That's not good news, guys. That is not what the Fed wants to hear. Let's dive into exactly what's going on with the stock market as it relates to the labor market, and exactly why investors are starting to see that the Fed is not going to reduce short-term interest rates. They will not cut interest rates this year. Here's the headline: Dow Jones falls after jobs data. When they say jobs data, they're talking about the ADP jobs data. So the ADP jobs data for the private sector comes out before the real jobs report, the federal jobs report that comes out on Friday, right? April 5th, right? That includes government jobs added to the economy, etc. ADP comes out with the private sector, just companies, regular companies. And that data that ADP came out with, guys, was not very good. It's good for the economy, but the jobs market for people. It's good for employees, it's good. But it's not good for the Fed, because the Fed understands in order for them to get inflation down to 2%, they need the jobs market, the labor market, to continue to soften. And that, according to ADP, is not going to happen. So therefore, if you can't soften the labor market, what happens? Interest rates stay higher for longer. The Fed is not going to reduce rates with a red hot labor market. They're not going to do it. So here's the headline: Dow Jones falls after jobs data. That means once ADP came out with their data, the stock market fell. Because investors now understand, wow, shoot, man, we thought we had this labor thing softening. We thought we were going to get 3 rate cuts this year. So on anticipation and enthusiasm, investors were investing. Now they understand that may not happen. Now they're starting to pull back and go where? To U.S. Treasury bonds. If you're watching what happened to U.S. Treasury bonds when the ADP data came out, it went up. Stock market went down, right? So that's where investors are starting to flee. They're starting to flee to safety now that they understand the Fed may not reduce short-term interest rates. They may not cut short-term interest rates. Plus, Jay Powell is going to be speaking today in California. So I'm pretty sure he may address the ADP private payroll job data that just came out. And then, of course, the major jobs report is coming out on Friday. So we'll see what that says. But ADP is saying we're still in a pretty robust jobs market. 185,000 private sector jobs added compared to what the analysts thought it would be about 150. So we missed expectations. That's not good for inflation. That's not good for the Fed making a case to cut interest rates. They're not going to cut interest rates when the labor market is still so resilient and booming, guys. So the Dow Jones Industrial Average dropped, basically the stock market. Dropped on Wednesday as Wall Street digested payroll data from ADP and awaited another speech from Federal Reserve Chairman Jerome Powell. So like I said, Powell's going to be speaking today in California. So the Dow Jones Industrial Average fell less than 0.1% in morning action. They're talking about this morning, Wednesday morning, while the S&P 500 dropped 0.1%. The tech-focused NASDAQ composite lost 0.3% after the opening bell. The 10-year Treasury yield climbed to 4.41%. Further, oil prices added to Tuesday's gains as West Texas Intermediate futures traded around $85.90 a barrel. So oil prices are up, right? Jobs market is still, according to ADP's data for March, robust. So guess what? Investors flee the stock market and they run to U.S. Treasuries. Treasuries goes up, stock market goes down. You don't got to be a rocket scientist to figure out why. Investors are fleeing the stock market, going to safety, because they are not sure, they don't have any clarity, they don't have any light at the end of the tunnel when the Fed is going to do what they need to do in order to get this thing right-sized. They have no idea. Not anymore. Every single month, the optimism from investors gets smaller. Last month, there was a 70% chance from investors. They thought 70% chance that the Fed would reduce short-term interest rates this year. That has fallen down to around 55%, guys. Less than a month. If the jobs data comes out on Friday, April 5th, and we miss expectations, that number is going to fall even further, which still will collapse the stock market and the crypto market, right? This is what's happening, guys, but it also poses an opportunity for us. So pay attention and I'll tell you why. Pay attention and I'll tell you why. It's the thing we got to understand. So here's it. Ahead of Wednesday's stock market open, ADP's employment data showed March jobs growth of 184,000, above estimates of 150,000, and up from February's 140,000. That's not good news, guys. That's not good news for investors. At least, you know, your institutional investors, your large hedge funds, your billionaire investors. That's not good news. For us as 99%ers, it's not all that bad news because we get to buy our favorite assets at a discount now. which is awesome. We get to build wealth. We get to build wealth by buying these assets at a discount right now. But that's what's happening. We're waiting on the jobs report. The main jobs report is coming out on Friday. This is the ADP jobs report, but it's only for private companies. No government entities or things like that, just private companies. But the economy added more private sector jobs than analysts thought it would add. The stronger the labor market is, guys, the less likelihood the Fed reduces interest rates. So that means your ability to borrow money is not real good because rates are going to stay higher. Companies' ability to borrow money is not going to be very good because interest rates are going to stay high, right? Your home ownership ability, for those of you who want to buy your first home, for those of you who want to upgrade to a home or downgrade because your house is too big and you're an empty nester, guess what? You're going to have to stay put. Interest rates are still high. Mortgage rates are still above 7%. And they're not coming down anytime soon. So get used to it. Unless this labor market softens more than it is right now, guess what? Interest rates are going to stay higher for longer. The Fed will not reduce short-term interest rates. They have no need. You got an economy that's doing well. Why? Because you got a strong labor market. Even though you got these people down here in the bust economy, most 99%ers are in the bust economy, they still participate because they got wages. They got employment. I just looked at a report this morning that talked about the personal savings rate. Less than half of Americans got $500 in their personal savings. We'll talk about that a little later. That's a shocking statistic, but it's not surprising. We blew through our personal savings. It's not surprising. So all I'm telling you here, guys, is you can look at this one or two ways. You can look at it as, oh, golly, the stock market's crashing, take my money out. I'm not going to put my money in that. There is no clarity. You can look at it that way. Or you can look at it as, you know something, what a great opportunity to buy my favorite ETFs and my favorite index funds at a discount and build wealth. What a great opportunity. You can look at it that way. It's up to you how you want to look at it. I'm just presenting the information to you to let you know where we stand right now as it relates to rates coming down. It's very important if we want to turn back on the money supply and for our small businesses and for the American people, the average American person, the middle class, the lower middle class, to be able to have access to more money, you need rates to come down. That's not getting ready to happen anytime soon. If this jobs report data that ADP just came out with holds up in the main jobs report that comes out on Friday. If it holds up, guys, I tell you what, stock market and crypto's in trouble. We're going to talk about crypto and what's happening to crypto as a result of what's happening to the stock market, because the two are tied together, right? Later in the day, Fed Chief Powell will provide comments on the economic outlook at the Stanford Business, Government, and Society Forum in California. His speech is expected at 12:10 p.m. Eastern Time. If you guys have access to the internet, you may want to pay attention to that. He's going to probably make some comments that will continue to affect what our assets do, right? He's going to make some comments that may affect what our assets do. We already know the first 3 days of April have not been boom days or rally days in the stock market. They've actually been sell-off days. And the reason they're selling off again, guys, is because institutional investors who make up 75% of the activity in the stock market, you and I, we make up about 25% of the activity. But 75% of the activity is by institutional investors, Wall Street firms, hedge funds, billionaire investors. These people move on clarity. They move when they know for a certain what's getting ready to happen in the future. Right now, they don't know that. They thought the Fed would be reducing interest rates 3 times this year. That has changed. And they've started backpedaling. See, because unlike you and I, they're not long-term investors. They're short-term investors. You and I are long-term investors because we're trying to build wealth. These people over here already got wealth. They're not interested in having something for 20 years. They already got wealth. They're interested in building their wealth, but short-term. See, they're short-term guys. We're long-term guys and gals. They're short-term guys and gals. We're long-term guys and gals. Two different ways of investing. They're looking for short-term gains. Why? Because they got pension funds. They got millions and millions of people who put their money in their fund to get income. So they're moving their money in and out of things quickly. You and I can't do that because we haven't built any wealth. We have to consistently put our money in assets and keep it over a long period of time so we can build wealth. Now, once we build wealth, we can start doing what they do. They move money into things and they move it out quickly. They'd rather go get a 5% money market rate short term for 60, 90 days on $1 trillion than to leave it in the stock market and lose 4, 5, 6 points on that $1 trillion. They'd rather move it out until they know the stock market is going to boom. Then they move it back in. Right now, their expectation is the Fed is not going to reduce these rates. That's the expectation right now because the labor market is preventing the Fed from moving on rates. They cannot move on rates in a downward fashion when you have a strong labor market like you have. It's too easy for inflation to go back up. If you got a strong labor market, I'm talking about a really strong labor market, plus you introduce cheap money to people through lowering interest rates, that's a double whammy. Inflation loves that. It will shoot back up quicker than you can even snap your finger. Inflation loves that. They love a strong labor market, plus you got cheap money over here you can borrow. You introduce those two things to the economy too fast and too quick, inflation goes back up. And that's what the Fed knows. So they're saying to themselves, hey, we're not going to make that happen. We're not going to do that. Why would we do that? Why would we do that? We wouldn't do that. We've not worked these last 2 years to bring inflation down to just let it go back up because we prematurely decrease rates, not with this strong labor market. So we'll see. We'll see how that works out, guys. But the first 3 days of this month, we can tell institutional investors, big time investors are not happy. They're not happy with what's going on with the Fed and interest rates. They're not happy, guys. They are not happy. They are not happy. And here's the effect all of this is having on crypto as well. Here's the headline. Bitcoin tumbles $5,000 in 24 hours as interest rates jump. Bitcoin. Remember last week, it had a resurgence, got itself back to all-time highs again. And guess what? This week, first 3 days, boom, it's down by 5,000. Why is that? It's tied to the stock market, guys. I know a lot of y'all out here don't want to admit that, but it is. It's tied to the stock market. So when the stock market goes down, interest rates are high, Bitcoin struggles too, right? Because you got pretty much the same investors. Same investors in stock market, a lot of those investors buy Bitcoin. A lot of those institutional investors that I just talked about, which is 75% of the activity in the stock market, a lot of those big boy investors are starting to buy crypto now. They're taking over the crypto space, especially the Bitcoin space. They're taking over Bitcoin. I'm talking about large companies, large hedge funds. Think about it. MicroStrategy, large company, owns $9 billion worth of Bitcoin, one of the largest whales in the world. Now you got BlackRock, Grayscale, ARK. You got companies like Tesla. All of these companies own major blocks of Bitcoin, guys. These are the new whales. What happens though? They stop buying Bitcoin when it when they know there's no certainty that their investment is going to go up in value at any time soon. It can't go up in value right now because rates ain't coming down. And now you're losing the enthusiasm. These big time investors, these hedge funds, these institutional investors, they're having enthusiasm fatigue. They've had enthusiasm for 3 months, waiting, chomping at the bit for the Fed to reduce rates so that they can make a really huge profit on their investment. Remember, they're short-term guys and gals. They're not long-term. They're not putting money in today and wait 10 years like you and I. They want to put money in today, and in 60 days, they want to make money and move out of it because that's what they do. They're short-term guys. We're long-term guys. The reason they can be short-term is because they're already got $1 trillion in their fund. Why can BlackRock be short-term? Because BlackRock has $10 trillion under management. That's why they can be short-term. There's plenty of wealth already there. You and I don't have $10 trillion in wealth. You and I barely have $500 in savings. So we got to have a different investment strategy than BlackRock. Oh, why can BlackRock do it? Because they got $10 trillion under management. That's why BlackRock can do whatever they want to do. Oh, golly, why can Vanguard do whatever they want to do? They got $8 trillion under management. They can do what they want to do. You and I don't have that. The 99% don't have that. We barely have $500 in savings. So we got to have a different investment approach. We got to look at what's happening now with the stock market and with Bitcoin. We got to look at that, especially the stock market, as an opportunity to buy. I love when the stock market is going lower like this on my favorite companies. I love when I can buy NVIDIA under $900 a share. Guys, we got to look at this as an opportunity to build wealth. This is one of the greatest opportunities in our lifetime. We got to take advantage of it every day, that we can buy these blue chip assets in the red. And while the big boys are fleeing and running, we should be buying. And then when they come back, our assets that we bought cheap will go up in value because now they're going to start pumping their money back into the stock market, into Bitcoin. Bitcoin fell for a second day to start the new month and quarter amid rising treasury yields and strength in the US dollar. So the US dollar gets strong. Like I kept telling y'all this, as the US dollar gets stronger, Bitcoin gets weaker. As the Bitcoin gets stronger, the US dollar gets weaker because they're currencies that compete against each other, right? They're currencies that compete against each other. So if the dollar strengthens, Bitcoin weakens. If Bitcoin strengthens, the dollar weakens because they're competing currencies. Treasury yields get stronger. Why? Because institutional investors, they flee to treasury yields for a guaranteed rate of return when they're not certain about what's going on with the stock market, when they're not sure if the Fed is going to reduce short-term interest rates. They flee because, again, guys, they're short-term. They already have billions and trillions of dollars under management. They're not trying to build, they're trying to increase that wealth that they already have. You and I don't have no wealth. So we gotta have a different strategy. Our strategy should be different. We should be loving red days. I get emails all the time. What should I be doing? It looks like the stock market is going down in value. No, it's not. It's a temporary thing. That's your opportunity to capture net worth. That's your opportunity when the 1% have fled. That's your opportunity to buy. And then when they come back, guess what? That investment goes up in value. So we got to look at it totally different as the 99%ers, guys. We can't look at it like the 1%ers. They get to move and ride. They get to move in and out of things because they're already wealthy. You and I are not wealthy yet, so we got to build wealth. So we got to stay in this thing and look for our opportunities to gobble up more when that opportunity presents itself. The first 3 days of April has presented itself an opportunity for us to build wealth, if we know that and we take advantage of it. The flagship Cryptocurrency fell more than 4.76% on Tuesday to 66,134. I looked at it this morning, it was under 65,000 a share. A coin. Bringing its 2-day loss to 7%, according to Coin Metrics. At one point, it fell below 64,572. On Monday morning, it was trading about 70,000 per coin. That's how quick though, guys. That data from ADP came out this morning. That shocked a lot of people because a lot of people felt like, okay, we're starting to get this softening in the labor market. So that means if we can continue this softening, not destroy the labor market, but continue softening it, the Fed will have no choice but to reduce short-term interest rates. Unfortunately, we didn't get that. According to ADP, we had a pretty good month in March to the tune of 185,000 jobs being added to the economy from the private sector. Plus, when the report comes out on Friday, we'll see what the government sector and these other sectors that are not considered private sector, we'll see what they add. If they add even more, and it's even a stronger report on Friday, you'll see more sell-off in the stock market. You'll see crypto sell off as well. That's what you'll see. But again, your attitude should be, come on, sell off so I can buy this stuff cheaper and then I can hold it and build my net worth. That's what you should be looking to do. That's what you and I should be looking to do, because we're not these guys over here. These guys over here already got wealth. They can move in and out of investments really quickly because they already have wealth. They already have expertise, right? They already have AI technology that helps them. We don't have any of that. We don't have any of that. All we have is a historical track record to lean on in our iPhone or smartphone. That's all we got. We don't got the tools they have. We just have history to say, okay, if the best assets in the world are discounted and I'm trying to build wealth long term, I probably should buy them when they're discounted and just hold them. And then at some point, they go back up in value. And now I bought them low. Now they're worth more. I just increased my net worth. I just got richer. So that's how we should be looking at it. We should be looking to sell great assets when they go down in value temporarily. That's the trap. They want us to do that. We shouldn't do that. We should be buying more, in my opinion, right? We should be buying more. Ethereum went down with it, losing 5.6% to trade at $3,240. So the two top cryptocurrencies, Bitcoin and Ethereum, also are feeling the effects of a resilient, strong labor market. The stock market is feeling the effects of a resilient, strong labor market. Guess what else? Housing market is feeling the same effects as well, right? Housing market is feeling the same effects. So here's one more thing on Bitcoin, and then we're gonna move on out of here. Bitcoin doesn't need much excuse to go through a period of correction after such an explosive performance in Q1 of 2024. Having said that, U.S. economic data has been stronger of late, and all while inflation continues to be a concern. So here's the thing. The economic data is still strong, but inflation is still high relative to where we want it at, which is 2%. So you got a strong economy, you got inflation that's sticky. You got to keep interest rates high just to make sure inflation doesn't go back up. And that's what the Fed is going to do, guys. That's what it's going to do. I've been telling you guys for weeks, it all hinges on the labor market. Everything hinges on the labor market. If the labor market continues to stay strong and resilient and adding a couple 100,000 jobs who knows when these people are going to reduce interest rates? Again, the 1% don't care because they made so much money in 2022. and sold. I'm sorry, they did make money in 2022 because they bought low. And then they held it to 23 and they sold at the beginning of 24 and made out like bandits. So the 1%, they're good. They'll just flee back to US Treasuries. They'll go back to money markets and wait this thing out. Again, guys, when you got 5% money market on trillions and trillions of dollars, that's a lot of money, man. But when you got 5% on $1,000, that's nothing. You got 5% on $2,000, that's nothing. But when you got trillions of dollars like the 1%, and you can get a 5% money market, or you can get a 2-year treasury bond for, I don't know, 4.5%, 4.75% on trillions of dollars, that's why they're short term and we're long term. We dealing with pennies, they dealing with dollars, right? But that's okay. We can take our pennies and buy these investments at a discount and hold them long term and build wealth. They're just telling you, having said that, the US economic data has been stronger of late, while inflation continues to be a concern. This has resulted in a repricing of Fed expectations. See, that's a fancy word for the Fed has to rethink this thing. Yes, we'd love to reduce interest rates 3 times this year, but you got to understand that, guys, we can't afford to have inflation go back to 9%. We can't afford it. We're not going to let that happen. So guess what? We'll rethink and change our minds and pivot and not reduce rates until we're sure that the labor market and the rest of the economy will be okay from a price stability standpoint when we do reduce these rates. That's exactly what they're saying. This has resulted in a repricing of Fed expectations, translating to broad-based US dollar demand on the more attractive US dollar yield differentials. So now worldwide, when you got a strong US economy, what does that do to the dollar? It's strong. The dollar is stronger. It's stronger on a global stage. When the US economy is doing good, guys, our dollar is stronger, which does what for the rest of the world? That's a good thing for the rest of the world because they transact business in the dollar. They transact business in the dollar. Now, you got some countries out there would like to not have that happen, like the BRICS nation. But at this point, people still transact business in the dollar. And when the dollar is stronger, that's good for them, right? That's good for them, especially if they got some old herky-jerky currency in their little country, but they can trade in the dollar. Shoot, they do better trading in the dollar than in their little, volatile currency. So that's what's happening right now. As our economy continues to be robust because of this jobs market, this labor market we have, then we're going to see interest rates higher for longer. They cannot introduce more money into our financial system when the financial system is already doing gangbusters without that money. You can't introduce cheap money when the economy is already doing good. You introduce cheap money when the economy is starting to, okay, now we might need to prop this thing up. Let's put some more money in here. That's when you introduce cheap money. That's when you reduce rates. You don't reduce rates when the economy is just booming. Now, again, it's booming for the 1%. Most of us down here in the bust economy, we're not booming. But we're not booming because we spent all of our personal savings, right? We spent all of our personal savings on trips, luxury items, pampering ourselves, going out to dinner, going out to bars, doing all that crazy stuff, right? After the country reopened, we just went crazy. Spent all of our personal savings. And then simultaneously, the Fed jacked up rates, so now we can't borrow money anymore either. And if we do borrow it, it's so expensive, we can't pay for nothing else other than the loans we got, AKA these car loans people went out and got. Anyways, I ain't got no other choice. I got to go get the 10.5% interest rate. I need this car. No, you don't. You did it anyways. Now you're paying the price. You got a 10.5% car loan rate that's choking the financial life out of you. You're upside down in the car because the average American who bought over the last couple of years, they're at least $6,000 upside down in their car. At least. If you bought over the last 2 years, you're at least $6,000 upside down in your car. Plus, you got a skyrocketed interest rate. But this is the stuff we do. These are the financial decisions we make. That's why we're living down here in the bust economy. Just saying, guys, we got to take ownership of some of this stuff. That's why we're down in the bust economy, because we've made not so smart decisions with our money. Bitcoin's move may have been exacerbated by a large Bitcoin holder, a whale who transferred more than 4,000 Bitcoin to Binance exchange late Monday night. Data from CryptoQuant shows a spike in that exchange's reserves, which typically signals a boost in selling activity. That coincides with the sudden drop in Bitcoin price late Monday night. So you got whales starting to do what? Dump. Now you got whales starting to dump because they're thinking to themselves, if Fed ain't finna reduce these interest rates anytime soon. See, here's what you got to understand about this Bitcoin and other assets, guys. If the Fed not going to reduce interest rates anytime soon, that means interest rates stay higher for longer. That means assets typically will go down when enthusiasm goes away. Now you're starting to see the enthusiasm go away. Now you're starting to see these assets go down in value. Why? Because the market is saying the Fed ain't going to reduce rates. Why would I be in the market if they're not going to reduce rates? Let me get out of here and go to safety. Now that enthusiasm is left, Bitcoin stocks are going down. But again, for people like you and I, that's not a bad thing because we're trying to build wealth and we're trying to get these great assets on the cheap. So that's not bad for you and me. It's bad for the 1%, but not for you and me. That's an opportunity for you and me. It's an opportunity for you and me to gobble up great assets at a discount. If you're a Bitcoin believer and you believe in Bitcoin and you're going to rock with Bitcoin, it's coming where you may be able to buy this thing cheaper than it is today and hold it. And guess what? What if the tide changes 3 months from now and the labor market is super soft? And for 3 months, you've been gobbling up these assets at a discount. The Fed start reducing rates and they go to the moon. Guess how much money you just made? Right? Just the money you just made. Let's say if Bitcoin does get itself down to 55,000 a coin and you buy some. 3 months from now, labor market softens, Fed reduces interest rates quickly, aggressively. All of a sudden, Bitcoin takes off, the stock market takes off, Bitcoin goes back to 70 a coin. You just made $15,000 a coin, just like that. Just by being patient and buying the dip. All I'm saying, guys, is for people who are trying to build wealth, that's not a bad strategy. Just get in the market, stay in the market, buy cheap, and wait for the boom. Because you know it's coming back. At some point, the Fed has to reduce short-term interest rates. They can't keep them there for the next 10 years. They're going to reduce them at some point. You should be buying until they do. And then keep buying. That's my thought process. You guys have to figure that out. I'm telling you what my strategy is. It's to just be in the market 365 days a year, every day in the market. That's my strategy. I never know when this thing is going to the moon, right? This rocket ship. Stocks tied to the performance of Bitcoin were dragged down, but traded off their lows to end the day. Crypto exchange Coinbase fell 2%, while software provider MicroStrategy, that's the company that owns $9 billion worth of Bitcoin, guys. MicroStrategy, which largely trades as a proxy for the price of Bitcoin, lost 3%. How do you 3% of 9 billion? That's what they lost. Well, not lost, but you know, they haven't realized the loss because they haven't sold anything. But 3% of 9 billion, you do the math on that. 3% of 9 billion. The largest mining stocks, Marathon Digital, Riot Platforms, lost 8%, 7%. Clean Spark, one of the best performing miners this year, slid 9%. Here we go. I keep telling y'all, crypto tied to the stock market. Stock market sells off, crypto sells off. But again, if you're a believer in crypto and you can buy it cheaper today than you did 2 days ago and hold it until rates come down. When rates come down, all your assets go back up in value, guys. That's the good news. That's why I keep telling y'all, keep rates high, buy these assets at a discount. As soon as rates come down, all of those assets you bought at a discount go up in premium and you make out like a fat rat. It ain't that hard, guys. It's not that hard. It's not that hard. You just have to understand the concept of that investing strategy. That's the strategy, right? That's the strategy. Here's one right here that I thought was pretty good. Here's one of the 1%ers, right? Billionaire. Here's what a billionaire is saying about the Fed and what he's saying about inflation. Sometimes, guys, you got to listen to these billionaires, man, because again, these people are privy to information you and I aren't. They're billionaires. They know stuff that you and me don't know. So I listen to them. Now, I may not take everything they say to heart, but I do listen to them and I read through what they say and listen to what they say to see if I can pick up any nuggets, see if I can pick up any golden financial breadcrumbs that they're dropping and telling me kind of what's coming. So this guy right here, Steve Cohen, who's a billionaire, right, says the Fed may have a hard time getting inflation down to its goal. He's telling you this now. This guy's a billionaire. He knows something you and I don't know. He's privy to conversations and information you and I will never be privy to, and conversations we will never be privy to. This guy is telling you something and you need to listen. Billionaire hedge fund manager. I told y'all he was a billionaire. Billionaire hedge fund manager Steve Cohen said Wednesday, that's today, that it will be difficult for the Federal Reserve to get inflation back down to 2% goal. Now, haven't I told you guys that over the last several weeks that we probably have a new normal? The new normal right now, guys, is probably 3% for inflation. We may never go back to the old normal of 2%. Our economy may not go back to that. And the Fed has to get used to that. They got to be able to say, well, okay, we got to reset the bar. The bar now is 3%. That's where price stability sits, at 3% instead of 2%. That's the old bar. That bar is gone. We may never get that bar back. We reset the bar at 3%, and now that's price stability in our economy. The Fed may have to do that. Now, they're reluctant to do it right now. They're stubborn. They don't want to do it, but they may have to. They may be forced to. And that's what this billionaire guy is saying, right? The Fed thinks it's eventually going to come down to 2% inflation rate. I think that's going to be hard. This is what a billionaire is saying, right? This guy knows stuff. I mean, they don't listen, guys, CNBC don't call me up and ask me to quote, comment on anything. They don't call me. They don't call you, but they go to the billionaires. Why do they go to the billionaires? Because these people know stuff that they don't even know. They're in the market. They know. So CNBC goes to this guy and says, give me your comments. What do you think? And he tells them what he thinks. Inflation was falling in late 2023, but there were several upside surprises in that data during the first quarter of this year that has led to concern among economists and traders that inflation may prove to be sticky above the Fed's target level, complicating the path for rate cuts. I've been telling you guys the new normal might be 3% for inflation. It may never go back to 2% again, right? It may never go back to 2% again. The point, 72 CEOs said Wednesday that there's a lot of underemployment in the country, which could create upward pressure on inflation if economic growth remains strong. See, you can't have this strong economic growth, guys, and you got interest rates at 5.5%, short-term interest rates at 5.5%. They don't go together. They typically don't go together. They typically don't, right? Typically, you want an economy that grows about 2% a year, keeps its head above inflation. That's typically what you want. Typically, you want a Fed funds rate under 2%, around 2.5% at best. That's your Fed funds rate. Maybe under 2%, just slightly over 2%. That's typically, that's the steady Eddie. That's the steady Eddie, 2 to 2.5% Fed funds rate, 2% inflation, 2 to 2.5 growth, GDP. That's the steady Eddie. Problem you're having now is in 2023, you had GDP at 3% and you had Fed funds rate at 5.5%. And you had inflation somewhere in that 3 to 3.5. Why would the Fed cut rates? They wouldn't. You don't cut rates until you have to. You cut rates to avoid something breaking. Right now, ain't nothing broke. Why would they reduce rates? They wouldn't. And now the market, these big hedge fund guys and these big institutional investors, they know that now, and they're fleeing. They're saying, okay, y'all ain't finna do nothing anytime soon. Forget that. Let's get out of here, guys. Let's go over here and get this treasury bond guaranteed by the government. Let's go over here and get this money market and just own our billions of dollars and we'll just wait. That's what they're doing. That's what they're doing. If growth is too fast, then you start getting constraints on labor and wages go up. All they're telling you there, guys, is comes back to what? Supply versus demand. See, the thing is if you introduce cheap money to the economy right now, what do you think is going to happen to demand? When you already got a strong labor market, people ain't concerned about losing their jobs because there's 2 jobs for every, candidate, basically. Ain't nobody scared about losing no job around here. So they know they got wages coming in. Plus, over the last year or so, couple of years, you've gotten some increases in wages. So people ain't worried about losing their job. Now, all of a sudden, you introduce cheap money to the financial system, into our economy. Just cheap money, low interest rates, that means cheap money. What do you think people are going to do with that cheap money? They're going to go out and buy crap. Yep, that's what they're going to do. And guess what they're going to do to demand? Through the roof. And what if supply can't keep up with that demand? What's going to happen to inflation? Through the roof. The Fed knows that. That's exactly what this guy is saying. You can't introduce more money supply to an already red hot economy and expect inflation not to do anything but stay right where it's at. That's not going to happen. It's going to go up. Why? Because you're going to get more demand. And at some point, that demand is going to outpace supply. And when that happens, inflation going back up. And guess what we do now? We all the way back to starting at zero again. We're jacked up interest rate, jacked up inflation, and delays our what? Wealth building, right? So we got to be careful with that. If growth is too fast, then you start getting constraints on labor and wages go up. See, why do wages go up? Because companies want to make more widgets. They need to make more widgets to keep up with the demand, with the demand. And if you want to make more widgets, a lot of times you got to hire more people to make more widgets. And you're going to have to pay them a little more because now they know you need them. If I know you need me to make more widgets, guess what I'm going to do? I might demand a little bit more money. You need me now. Right? And that's what this guy's saying. If growth is fast, if growth is too fast, then you start getting constraints on labor and wages go up. And that may be a problem. We're in one of these problems where I don't think many people know exactly what is going to happen, which we don't. Even your big boy Wall Street, big boy blue chip don't know what's going to happen. That's why they're moving their money out of the stock market, guys. They ain't moving it because they know exactly what's happening. They're moving it because they don't know what's happening. They're moving it because they're saying, hey, I'm already rich. I ain't trying to lose my rich. I'm trying to keep my rich. You and I can't do that because we ain't rich. We ain't wealthy. That's why it's an opportunity for us, because we ain't rich. We ain't wealthy yet. We trying to get there. But this is how we get there. When they move and get out, that frees up us to buy all this stuff cheap. And then when they move back in, when they get some certainty and some clarity and they know there's a light at the end of the tunnel and they start moving back in, all those investments we bought go back up in value. I've done that for 25 years, guys, just consistently in the market, not really caring about what the 1% do, just doing my thing, building wealth, buying great assets at a discount and holding them. That's all I've done over the last 25 years, and it's worked out fantastically. Despite the concerns on inflation, Cohen said he doesn't disagree with market estimates of 3 rate cuts this year. I think inflation's been somewhat contained, and I think ultimately it will come down to, is that a true statement or not? Cohen has also expressed general confidence in the stock market. He said the current market rally is not a bubble like 1999 dot-com bubble. It is instead due in part to investors pricing in future growth from artificial intelligence. AI. He's saying investors are coming in, investing now in the future, which is AI. I don't disagree with that. I think it is the future. I think if they can create robots that can do what you do, they're going to put robots in there. You shocked by that? Do you know what country we live in? We live in a country that's capitalistic. We live in a capitalistic country. It's a dog-eat-dog country. It's a you eat what you kill country. They don't care anything about you. They can put a robot in your place and do what you do, and they ain't got to pay that robot. Guess what? They're going to do it. Now, you know that, so what do you need to do? You need to plan for the future. You need to plan for the future. The only way you plan for the future, guys, is you got to have assets. You got to have assets. Or these robots, at some point, they're going to get you. The robot going to get you at some point. Artificial intelligence is going to replace you at some point. Unless you own your own farm and you're out there, doing your own thing, you own your own business, it might not replace you. But if you work for somebody, especially you work for somebody that at some point robots can do what you do, you're going to get replaced. It's just a matter of time, guys. So plan now, get yourself in a position where you're buying assets to make sure you put yourself in a place not to allow that to happen. That's the best thing you can do. Put yourself in a place where you don't allow that to happen. Put yourself in a place you don't allow that to happen. Cohen said that AI is really durable theme that will make an impact on a wide variety of companies. You see what this billionaire is telling you? AI is really durable. See, AI don't need no days off. They don't need no medical insurance. Ain't no workman's comp. Ain't no, none of that. Ain't no on the job for 8 hours, but you take 5 hours of those 8 hours scrolling through your Instagram feed, looking at TikTok. No, AI don't do any of that. Telling you guys, these people ain't investing in AI technology for nothing. This guy is telling you right here, AI is really durable theme that will make an impact on a wide variety of companies. If you're a company and you're not thinking about this, you're going to wake up one day and go, we're in trouble. See, that's you. You're going to wake up one day and go to your job and there's going to be a robot sitting in your seat. And they're going to, Richard, come in here for a second. This robot has taken over your spot. Here's a 2-week severance. Thank you for your 30 years of service. The security guard will show you out. That's what's going to happen. I'm telling you, that's what's going to happen. They're not going to tell you that, but that's what's going to happen. Thank you for your service, Richard. You've been great. Don't take that coffee mug. Leave that here. That's ours. Only take what belongs to you. Security, walk him out. We've given him his check. Get out of here. The robot takes over. I'm just telling you, that's what's going to happen to a lot of us if we're not prepared. If your company and you're not thinking about this, you're going to wake up one day and go, we're in trouble. Cohen has a long history of successful stock trading, and he made much of his fortune as a hedge fund manager for SAC Capital before the firm was shuttered following a regulatory investigation. He also owns the New York Mets. These big boys, man. These big boys. This guy's a big boy. Big boy, blue chip, billionaire. Owner of the New York Mets baseball franchise. These guys ain't messing around, man. So if you don't want to listen to me, you might want to listen to him because he's a billionaire. He has an idea of what he's talking about. He has an idea of what he's talking about. And now to wrap this thing all the way up in a nice little bow and present it to you, we're going to talk a little bit about where you're currently at with your savings. Because this is the key, guys. This is not some make-believe world we live in. This is the real world I'm finna share with you about where Americans are with their savings. And what you should be thinking about is this me? And how do I change this? How do I change this over the next 10 years? How do I put myself in a position over the next 10 years to change this? Here's the headline. How much money Americans have in their savings accounts. Nearly half have less than $500. That's the headline, guys. Nearly half of Americans have $500 or less in their savings accounts, an amount that leaves them vulnerable to unexpected expenses. Right? About 29% of respondents have between $501 and $5,000 in savings account, while the remaining 21% of Americans have $5,001 or more. Sad, guys. Few hold much cash in their checking accounts as well. Of those surveyed, 60% report having $500 or less in their checking account, while only about 12% have $2,001 or more. The lack of cash in either savings or checking accounts suggests that many Americans are living paycheck to paycheck. This leaves them vulnerable to unexpected expenses, underscoring the importance of having an emergency fund if they're able to build one. Does that sound familiar? Haven't I been saying that to you guys for the last 4 years on this YouTube channel? You got to have an emergency fund. You got to have 3 to 6 months of expenses tucked away in a safe place, just in case you hit a financial bump in the road. Guess what? Many Americans don't. So y'all ain't alone. For those of y'all that don't have that, you're not alone. You got millions and millions and millions and millions and millions and millions of people out here in the same boat as you. And I'm going to be honest with you guys, for 99% of us, that's a personal choice. That's that 1% out there that just a curveball came at them and they couldn't hit the curveball. But for 99% of us, we just made a raggedy choice with money. For 99% of us, we just made a raggedy decision with money, right? Financial planners commonly recommend keeping a reserve of cash, such as an emergency fund, on hand to cover unexpected expenses. Yet Americans don't seem to have one. That's how it is in this country, man. We feast or famine in this country, boy. We are feast or famine, right? Either we take every penny we got and spend it. We will take every penny we got and spend it. Every penny. We are a country of spenders, not savers. There are many reasons for this. In some cases, Americans may struggle to make ends meet during times of high inflation. But in others, it may be a matter of affluent professionals who are in the habit of not saving. The inability of Americans to withstand an emergency costing $500 or even $1,000 can be financially detrimental, with a domino effect in their life, such as Alex Lorenzo, a certified financial planner and founder of Lorenzo Group Management. That's because people often rely on high interest credit cards to cover unexpected expenses, he said, which is true, which is absolutely 100% true. Accumulating debt can lead to a cycle of repayment and interest charges that can be difficult to escape. An emergency fund helps you avoid falling into this debt trap. I've been telling you that for years. Get yourself an emergency fund, 3 to 6 months. Avoid falling into this trap. Avoid falling into this trap. Just sad, isn't it? Just sad. Just sad, sad, sad. So what should we be doing as investors? In a situation where interest rates are high, the job market is still pretty resilient, so we know the Fed is not going to reduce interest rates anytime soon. The stock market is starting to sell off. The crypto market is starting to sell off. The housing market, a lot of us are waiting on something magically to happen in the housing market, but it's not. Why? Because interest rates are high. You can't go get a mortgage at a decent rate, so you can't afford the monthly payment, so you can't buy a house. You can't buy a house. And in some markets, rental rates are starting to go back up because of that. In some markets, people can't buy houses, so guess what? Landlords are getting smart. Well, we know these people can't afford a house. They can't buy no house. So I'm going to go ahead and jack my rent up another $100 a month. Where they going to go? What they going to do? They can't buy a house. They don't got the down payment money and they can't afford the monthly payment. So guess what? I'm going to jack my rent up by $100 a month, another $150 a month. That's what landlords are doing. They're taking advantage of the ability, your ability to be able to go somewhere else, AKA buy your own home. They know most of us can't do that right now, especially first-time home buyers. We don't have the down payment and we can't afford the monthly payment. So landlords are sort of in the catbird seat. Why y'all think y'all see all these apartment buildings going up around you? Why do you think you see all these apartment buildings going up around you? Because they know that. Why do you think you got companies like BlackRock and others like that building these renter communities? It's 900 of them across the United States where they go in and build subdivisions, cookie cutter homes, subdivisions, 1,000 of them. All of them are rental properties. Giving you the illusion, right? They're giving you that illusion, but you don't own nothing. You rent, you don't own nothing. And I'm not saying that's a bad thing. I'm just telling you that's where we're at today. We don't even have $500 in our savings to cover an unexpected. So what are you going to do? You're going to sit here and not build wealth. You don't have an emergency fund. You can't buy a house. The only way you change all of that, guys, is through assets. You got to start developing multiple streams of income. And then you take that income and you got to start buying assets like paper assets, right? Maybe you start a business that you can actually build that business into a profitable business and you can get income from that business and then take that income, invest it in things that grow on its own. Real estate right now is not a bad investment if you're an investor. If you can afford to absorb the 7.5% interest rate and steal the property cash flows, it's not a bad idea. And the reason it's not a bad idea is because you got sellers out here who got properties on the market that can't sell them. You can go in and negotiate a really good price. A lot of these sellers have seller fatigue. They're ready to get rid of these properties. They just don't have anybody coming to buy them from them. So if you go in as a real estate investor and you got down payment money, you can absorb that 7.5% interest rate, property still cash flows, why wouldn't you just buy it? You do know when interest rates come down, the values in these properties are going to go up higher. You know that, right? I've been telling you, interest rates go down, asset values go up. Real estate's no different. Why? Because you're going to have more demand. You already don't have that much supply. So if you're a real estate investor and you got decent credit, You got verifiable income. You got down payment money. You can absorb the 7.5% interest rate and still cash flow the property. Why wouldn't you buy now? I think you buy now. 6 months from now, when rates come down by 75 basis points, 100 basis points, guess what that's going to do to mortgage rates? They're going to come down by that as well at some point. And that's going to introduce a whole new section of buyers. That's going to increase demand. Interest rates get to 5%, demand is going to go bananas. And if I got a couple of properties that I'm holding on to, when that demand goes banana and I don't have a lot of competition, I got more people looking, more people able to buy. Since rates go down, my property goes up in value. That's not a bad way to go right now, guys. If you're financially bankable, if you're bankable, think about real estate. Oh, I'm just going to sit on the sidelines until it goes back down to pre-pandemic prices. That ain't never coming back, guys. That pre-pandemic stuff ain't coming back. So while you're sitting up here waiting on it, I don't know. It's not coming back. Pre-pandemic real estate prices are not coming back anytime soon unless something cataclysmic happens to force it. Unless a 2008 happens, which I don't see that happening because we don't have an oversupply. See, the thing that crushed 2008 was you had more. At some point, you had more supply than you had demand. That's what crushed 2008, right? You had more supply from speculation than you had demand. See, once supply passed demand, everything, it was downhill from there. Credit quality started deteriorating because why? Banks were allowed to give people stated income loans. Zero down loans. Your credit could be raggedy. They didn't care. They give you a loan. So you got all this bad debt, these bad loans out there ready to kind of tip over. And when those bad loans started tipping over, and then you had all this supply, the demand dried up. That's what happened in 2008. You don't have that in today's environment. Why? Because you don't have any supply. You don't have demand right now, but you also don't have an oversupply. You have an undersupply, even with the low demand that we have. You still have undersupply. That's why you see real estate prices on these homes in a lot of markets are not rapidly coming down. They come down a little bit, but then they go back up. They come down a little bit. Every time interest rates come down, you see a little bit of a jump in home prices. Why? Because that introduced more demand. And what do you think is going to happen? At some point, the Fed is going to reduce these rates. I don't know if it'll be in 24, but at some point they will. When they do, your long-term rate is coming down too. And when that long-term rate comes down and you got all this pent-up demand to buy real estate, when that hits the market again, real estate prices going back up. Wouldn't it be nice for you to capture some of that equity? But you got to be in the right position. You got to be bankable in order to do that. You can't be around here with bad credit, no verifiable income, no down payment money, and think somebody's going to lend you money. That ain't going to happen. That's la-la land. It's not the real world, guys. The real world is you got to be responsible. You got to be financially responsible. You got to be bankable. Then you can go anywhere and buy anything. You can use 5 to 1 leverage anywhere to buy real estate, right? So you got stocks. For those of you that like crypto, hey, y'all know I think crypto's a pump and dump. It ain't my thing, but hey, if you want to build wealth with it, build wealth with it. There is a way to build wealth with crypto. You just got to know what you're doing. It's not like traditional investing. It's not. So you got to know what you're doing with crypto to build wealth. But if you know what you're doing, it might be an asset class for you to take a look at. Certainly real estate is for income, and then certainly businesses. So you got 4 asset classes right there, right? 3 of them I use, but you can use all 4 if you choose to. But this, in my opinion, is the right time to do it right now. Right now, for the next 10 years is the right time to do it, in my opinion. You do whatever you feel like you need to do. But in my opinion, right now, there is no better time to build wealth when the 1% are fleeing. The 1% have left. They're leaving. So assets are a little bit cheaper. What is NVIDIA trading at today? Let me see what NVIDIA is trading at today, because I may go buy me some NVIDIA today. Let me look and see what it's trading at. Let me see what NVIDIA is trading at. So NVIDIA right now is trading at 901.38 a share. That's too expensive right now, right? But if it gets itself down anywhere in that 850 or lower, I'm gonna buy some. So I'll keep watching it. Now, of course, I'm buying it in my Magnificent Seven stocks. I'm buying it, but I'm talking about another little extra I'll buy if it gets down to at least 850 a share. Let's see what Tesla's doing today, because y'all know I'm buying Tesla at 150 a share. So let's see where Tesla is today. Tesla's 168. So Tesla's not quite where I need it to be. It's at 168. So I need Tesla 150. I need NVIDIA 850. If any of those things happen, I'm in. Now, a lot of y'all might say, oh, that's timing the market. No, because I already buy the Magnificent Seven every single month. So I'm not timing the market. I buy the Magnificent Seven every single month, no matter what the price is. This would be my reserve cash that I would take off the sideline and put into something and deploy it. But I'm only going to deploy it at the right target price. That ain't got nothing to do with timing the market. That's just an investor decision. Because I'm in the market 365 days a year. Every day I'm in the market. Every day, 365 days a year, I got 7 figures in the market. 7 figures are in the market 365 days a year. So I'm in the market. I'm in there. I'm on the rocket ship, strapped in, ready to go. 10-year plan, double my net worth in 10 years. That's the plan that I'm on. All I'm telling you is there are opportunities right here to buy some of your favorite companies at a discount. Big opportunities. I mean, haven't you seen what NVIDIA has been doing? I believe by the end of 2024, I got no scientific proof of this. I'm just giving y'all my guess. My guess is by the end of 2024, NVIDIA could be a $1,200, $1,500 a share stock, man. That's what I believe. Got no scientific proof of it, but I believe if they continue to do what they're doing in the chip making and AI space, they're gonna be $1,200, $1,500 a share by the end of this year, especially if the Fed reduce rates. But y'all should be looking for opportunities to gobble this up. Remember the option that I gave you earlier on in the live, where you can actually get the Magnificent Seven stocks, all 7 of them, for free. Fractional shares of the Magnificent Seven stocks for free. All you got to do is go down to the description box, click on that Moomoo link, open up your Moomoo account, put $100 in it. Moomoo is going to give you all 7 Magnificent Seven stocks, fractional shares, for free. You're going to have a fractional share of NVIDIA, a fractional share of Tesla, a fractional share of Apple, a fractional share of Meta, a fractional share of Microsoft, a fractional share of Amazon, Alphabet. How can you pass that up? It's a fractional share of the Magnificent Seven. 7 stocks. Put $100 in your brokerage account. Link down in the description box. You guys go click on that link. Open up your Moomoo account. What are you waiting on? Go build you some wealth. Go build you some wealth, man. Stop waiting around, waiting on somebody to tell you what's going to happen. You already know what's going to happen. Either you're going to build wealth or you're not. And you'll pay the consequences or enjoy the consequences. You'll pay for it or enjoy it, depending upon how you act today, right? You'll pay one way or the other. You either going to be on the upside of it in enjoyment, or you're going to be on the downside of it in misery. You got to act, guys. You can't sit around and not build wealth and think at some point in the future, something magically is going to take care of you. There is no magical nothing out there that's going to take care of you. You better start building wealth today to take care of yourself. There is nothing out there that saves you. You got to save you. You have to save you. And you do that through purchasing assets. And you do that month after month, year after year, decade after decade if you have to, depending upon how much money you put in. My plan I always talk to you guys about is take $1,000 a month and put it in something. You can copy my plan where I'm buying these 3 big boy blue chip paper assets. I call it my wealth transfer blueprint. You can copy that, or you can create your own. But take that $1,000 a month and you put it in something with at least an 8% rate of return on average over 10 years. You've just added a couple $100,000 to your nest egg, to your pot of gold at the end of the rainbow, just like that. Boom. Taking $1,000 a month. Where do I get that from? You make more money. You keep more of that money that you make. You don't spend it to make someone else wealthy. You don't treat yourself to all these crazy trips and all this decadence and all this pleasuring and all this entertainment. You do away with some of that crap. Take the $1,000 a month and put it in something that actually builds wealth and creates passive income. That's what you do. That's what you do. You take $1,000 a month, 8% rate of return. Where do I get an 8% return, Richard? Well, the S&P 500, for one. Last 10 years, 12% rate of return. First 90 days of 2024, 10% rate of return. Magnificent 7, first 90 days of 2024, 17% return. Guys, it ain't rocket science. It's just following a proven pattern. Following a proven blueprint. It's not rocket science. It's just following a proven blueprint and just being disciplined enough to hang in there. Being consistent enough to hang in there. Being patient enough to hang in there. That's the key. If we would get comfortable with that, we're gonna be good to go. You do that for 10 years. Okay, what about that? Well, what if I did $2,000 a month for the next 10 years? Well, shoot, great. How do I do $2,000 a month? Earn more money and keep more of it. Earn more, keep more. That's how you do it. Well, my job only will pay me, well, get another job or get you 2 or 3 side hustles. If it was easy, everybody would be here. If it was easy, you wouldn't have half of Americans couldn't afford a $500 little hiccup in their life. If it was easy, it's not easy. It's hard. That's the whole point. $2,000 a month, 24 a year, 8% rate of return. I got $350,000 in my pot of gold at the end of the rainbow nest egg. That's what I got in my nest egg. I got over $350,000 in my nest egg. 8% rate of return, S&P 500, at least an 8% return over a 10-year period. How do you know it'll do that? Because the track record says it'll do it. I can't guarantee you anything. I'm not your financial advisor. I'm just telling you what the track record says. That's all. I'm going off of the track record. I'm going off of a 90-year track record. The 90-year track record says it'll get between 7 and 10% rate of return. That's what the 90-year track record says. How can I argue with 90 years of proven performance? Now, you may want to argue with it, but yet and still, you'll go into a crypto investment that's been around 2 seconds and argue till the cows come home that you're going to get rich doing it. But you'll look at a 90-year track record and oh, it won't do that. It can't do that. You don't know it'll do that. But you'll get in a crypto pump and dump with a 2-second track record and give people thousands of dollars. This is how we are. This is what we do. Why? Because see, one represents quick, get rich quick. The other one represents get rich slow. See, one represents get rich quick. You don't have to do anything, instant gratification. And the other one represents get rich slow. You're going to have to give up something. You're going to have to grind. You're going to have to sacrifice. We don't want that. We don't want that one that's slow with a grind, sacrifice, giving up something. We don't want that. We want the get rich quick. I don't have to sacrifice nothing. I don't have to give up nothing. I could just give you this money and in 24 hours, 48 hours, I'm gonna be rich. I gave y'all the story yesterday of this young lady that emailed me. She put $11,000 in a crypto scam. 11 grand. Now here's the rub. They fabricated all kind of documents to show her that her $11,000 had turned into some six-figure number. Just fabricated documents out of thin air. So she goes to ask for give me my profit. They said, well, hold on. The only way we can give you your profit is you got to pay us another 4% cash before we can give you your profit. Now, where you ever heard of investment like that? See, this is what we do though when we're get rich quick, not get rich slow. When we get rich quick, this is the schemes we fall into. So you mean to tell me I already gave you 11,000, you're telling me it grew to six figures. Now I want to take my six figures, but you're telling me I got to give you another 4% based on what I'm trying to take or the value, something like that. So I got to pay you money more to take money out. I got to pay you more to take money out that you're saying my investment has grown to. I've never heard of an investment where I got to pay you to take my capital gains out. I've just never heard of that. But this is what we do when we're not laser focused on real investments that have a historical track record of performance. This is what we do. We get into some private thing that somebody from the church say we should do, or somebody from the PTA say we should need to do, somebody from the Little League team say we need to do, one of our neighbors say we need to do. We get caught up in that. Next thing you know, you're out of your money. You got lost your money. Guys, we got to get out of this. We got to get back to traditional, everyday investments that we got to pay the price. We got to sacrifice something. We look at historical track record. We got to get back to that. That's what I've hung my hat on for 25 years. Buying real estate for income, just taking my time. I wasn't in no rush. I wouldn't mind buying real estate, but I want to buy 5 properties at one time. Well, how about buy one first? Let's buy one first and really figure out how that process works, and then let's buy another one. How about we do that first? How about let's not try to go get a 100-unit apartment complex when we got bad credit, no down payment money, no proof of income, no experience running any type of real estate property, but we want to go right off the bat and buy a 100-unit. It's just stupid, in my opinion. But see, we listen to these people on YouTube, we listen to these people on TikTok, we listen to these people on Instagram, we look at all these dumb podcasts with these fake millionaires, these ridiculous people on there telling you, oh yeah, you don't need any of this. Oh, let me teach you how to go to what is called Navy Federal. Let me teach you how to go to Navy Federal and scam them out of money for some fraudulent car loan that you don't really need the money for a car loan. This is what we listen to. Let me teach you how to beat the man. Let me teach you how to defraud the credit card companies. Let me teach you how to scam people into real estate deals that there really ain't no real estate deal. Let me teach you how to scam people. Let me teach you how to lie. This is what we want to listen to. Why we want to listen to that? Because it's get rich quick. See, since we've come out of this bondage that we've been in as a people, somewhere along the way we lost something. Because I know our ancestors wasn't like this. Our ancestors wasn't like this. They were hardworking people who took pride in their family. They took pride in a hard day's work. They took pride of whatever little they owned it. We lost our way somewhere. Now all the thing we want to do is get rich quick and envy people on social media and get trapped in the schemes and paying people $50 a month behind paywalls on OnlyFans. How in the world would I listen to some joker on OnlyFans about my financial freedom? And I'm paying him $50 a month to look at his fake Lambos, look at his fake Airbnb houses he living in, his fake jets, his fake jewelry. This is what we've come to as a people. This is what we've come to. We've come to as a people where we value entertainment over education. This is what we've come to. Well, we value entertainment over education. I'd rather watch a skit, some funny, than to watch anything about how to build my wealth the right way and get to my pot of gold at any rate. You give me the choices, I'm going to go with the funny. I'm going to pick the funny 9 out of 10 times. We're going to pick the funny. We're going to pick the gossip. We're going to be the victim. We want to play the victim. We've turned into playing the victim. Our ancestors didn't play the victim. Those people who fought for our freedoms and our rights in this country in the 60s, the 50s, the 40s, the 30s, the 20s, they didn't play the victim. They were strong people. We've turned into these, I don't even know who we are anymore. I turn on the TV, looking at a video. You got our beautiful queens in videos with their whole, everything showing. Everything showing. Would that make our ancestors proud? We got guys, young men, calling women everything but a child of God. Do you really think other groups of people are going to respect us if we can't even respect ourselves? Really? Do you really think other groups of people are going to take us serious and respect us on any level when we don't respect ourselves? Really? Come on, guys. We got to grow up. We got to stop this. It's embarrassing. It's a shame. But this is what we've evolved into. That's why we are at the bottom of the financial totem pole in this country. Every group of people financially are ahead of us. The only thing we lead the country in is spending money. That's the only category financially we pretty much lead the country in. Spending money. But when it comes to building wealth, we're at the bottom, dead last. I'm talking about people who just getting here. I'm talking about people who just getting here ahead of us. And we've been here for 400 years. Now I know we'll go back and we'll make all the excuses. We've become very good at excuse making too. We'll go back and look at all the excuses why we where we at. That's great. That's great because that's where they want us at. They want us to live in the past. They want us to live in excuses. Therefore, we'll never look to the future. We'll never become better. We got to evolve, guys. We got to evolve for the better, not for the worse. We're evolving for the worse. There's no way 50 years ago, anybody, our people wouldn't have done the things that we're doing today. We got to do better, guys. If you want respect, respect yourself first. If you want wealth, build it. There's nothing in this country stopping you from building wealth but you. There's nothing stopping us in this country from building wealth but us. We're at the bottom of the totem pole because of us. Because of the choices we make with our money. Because of the relationship we have with our money. I don't know one, it's terrible out there. The advice a lot of people are giving. It's terrible. It's terrible advice. How do you let somebody on your podcast that teach people how to scam banks How do you do that? How do you sleep at night when you allow somebody on your platform to show your people how to do illegal things? And here's the thing that really kills me. Those people get hundreds of thousands of views. So somebody watching. How do you have a funny skit that does 50, 60, 70 million views for some funny entertainment deal, but you got somebody over here trying to educate you to build wealth and you don't even show up? But yet and still, we've been mistreated. We're the victims. But we won't even support our own people. The crab in a bucket mentality. Through our music. Through the things we do every day. We got to get better as a people, man. Because if we don't, the future is not bright for us. We represent 14, almost 15% of the population in this country. But we only control 3 to 4% of the wealth. Does that math add up to you? We represent almost 15% of the population, but we only control 3 to 4% of the wealth. And here's the scary part, guys. That's going down. Before you know it, we're going to represent 1 or 2% of the wealth in this country, which is a nothing burger. Every other group of people will be ahead of us. We're already at the bottom. We got to change the way we think about money. We really do. We got to start building wealth the right way. We got to work, we got to earn, we got to keep what we earn, and then we got to multiply what we keep the right way. Not this get rich quick, I'm going to give you this, you give me that. Oh, this is how you go get a car loan and you don't even really have to go buy the car. I mean, who teaches people that other than our people? Who teaches people that? I mean, come on, man. Who teaches people that? Oh, this is how you can beat the credit bureau score. You can buy a trade line. You can lie. You can do all this on the credit report and clean up. Who teaches people that? You do understand if you don't correct the wrong behavior with the right behavior, you know you're doomed to repeat the wrong behavior, right? You do know that, right? Anytime I take a shortcut and I missed the long way to take a shortcut so that I don't have to learn nothing, you do know I just repeat that old bad behavior, right? This is the stuff we're teaching our people. This is it. We're kings and queens, but yet and still we walk around calling each other derogatory names. But yet and still, if somebody else calls us that derogatory name, we ready to go off the handle. But yet and still, we can call each other that derogatory name. But if somebody else calls us that, oh my goodness, World War III done erupted. But we can go around and just use it like it's a term of endearment. That's not a term of endearment, guys. None of us should be calling each other that. And no one else should call us that. But first of all, we shouldn't call ourselves that. How do we go from kings and queens to that word? By our own people. It's one thing if another group of people are calling you that, but how can your own people call you that? How do we go from kings and queens to that? We call ourselves that. How do we go from that? How do we go from kings and queens to this? How? When did we lose our way? When did we lose our way? And how did we allow people to trick us, to lose our way? See, I have a theory on where we lost our way. But how do we allow other groups of people to trick us into that? And the crazy part about it is they're still tricking us. When you look at the music industry, you look at the prisons, who are the players? Who are the common players in those two industries? Who are the owners of those two industries? And who are the workers in those two industries? So you got owners and workers. Which one are we? Which one are we in those industries? In the prison industry and in the music industry, which one are we? Are we owners or are we employees? Just to name it a good term. Which one are we in those two industries? Because those are two industries that we are very, very, very intertwined in. Prison industry, music industry. Those are, and let's throw in athletics. Those three industries where we're really, really intertwined in those industries. Are we employees or are we owners? I don't know, you tell me. Prisons, music industry, athletics. What are we? Are we owners or are we employees? Are we shareholders or are we stakeholders? Do we make the decisions or do we follow the decisions? Which one? Do we make the decisions or do we follow the decisions in those three industries? Are we employees or are we owners in those three industries? Are we shareholders or stakeholders in those three industries? See, here's the sad part about it. In a couple of those industries, we believe we're the ones. We believe we control it, but we don't, because we don't have ownership. We don't have ownership of the music industry, and we don't have ownership of these athletic teams. We don't. We don't have any ownership. We're employees. And the crazy part about it is we have been manipulated to the point where we will do anything they tell us to do, all for the mighty dollar. Anything. We'll say anything in songs. We'll denigrate each other in songs. We will have whatever they tell us to do. If they dangle a bag of money in front of us, we do it. But yet and still, when we get that bag of money, we do nothing with it other than give it back to them. They give it to us, but they know exactly we're going to give it right back to them. And that's what we do. We got to change this, guys. But it's up to us. It's up to us. Well, guys, I'm done for the day. Thank y'all. I appreciate y'all for rocking with me. Kind of lost myself at the end there, but it's just sad to see what has happened to our people. It's sad. It's sad. It's hurtful to see how we've deteriorated into what we've deteriorated into. It's just sad. Especially when we look at where we came from. We came from such a great and proud people. We had very little, but we had each other. We had family. We had God. Now we've morphed into something where we don't have family, we don't have God. We got nothing but a bunch of things. That's all we got. We got nothing else. And we're at the bottom of the financial barrel in this country, dead last. Every other group of people are ahead of us. Why? Why are every other group of people in front of us? That's what we got to figure out, right? Well, guys, I appreciate you rocking with me. Thank you for checking in today. I'll be back tomorrow at 10:30 a.m. Eastern time with more new content on financial matters across the United States that can affect us and hopefully help us get to financial freedom. Maybe at some point we'll choose to do that. Maybe at some point we'll step up as a people, grab a hold of each other instead of pulling each other back in the crab bucket. Maybe we will all hold hands and come out of the crab bucket together at some point. My job is to continue to be optimistic and sharing this financial content. So at some point, hopefully we will do that as a people, for all people. My channel is for all people, but you guys know that rock with me, we are a people that are in trouble. And it's up to us to get out of that trouble. No one's going to save us but us. Hopefully at some point we will save each other. Hopefully. One helps the other. That's what we got to do. One helps the other. We got to get our dignity back. We got to stop allowing people to make us do things that we don't want to do, that are detrimental to our people. We got to stop that. We got to do better. We got to stop blaming others, take responsibility for what we can take responsibility for, and do better. Lock it in with a thumbs up, guys, before you get out of here. I appreciate you. I appreciate you rocking with me. Like I said, if you want those 7 free stocks from Moomoo, click on that link down in the description box. Moomoo is going to give you they're going to give you 7 free fractional shares of the Magnificent 7 when you put $100 in your new brokerage account. They're going to give you that as a thank you for trying their brokerage app. So you get 7 fractional shares of the Magnificent 7 when you put $100 in your brokerage account. If you want to take advantage of that and start changing something in your financial life, go down to the description box, click on that Moomoo link, open that account today, go get that free stock, go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash that like button for me. I really would appreciate it. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy, get wealthy, and I'll catch you guys on the next one. Peace.